We're going to jump in right into the heat of this market, the heat of this moment, and we're going to talk about all the important things that are causing the most angst and are attracting the most focus. Yes, I am in a different location today. Same house, same location though. Different room, changing up the setting. So first thing I want to talk about, and I do have notes for today's video, we are changing the format just a little bit. I'm going to start bringing in notes a little bit more. I'm going to start making videos slightly less often. That's not because I'm trying to do any less work. That's because I'm trying to continue to increase the quality of the videos and decrease the repetitiveness of the videos. So let's see how this video does. So oil is taking a pretty big hit today on the idea that China is weakening. This is quite interesting, and this has been somewhat of a drag on oil at various points throughout the year. However, it's important to remember that China has been weak all year. That has been the thing. It's not like yesterday was some sort of revelation that China was weak. We got some seriously bad China numbers last week. We've been consistently getting bad China numbers all year. They've been at record low youth unemployment rates for several months now. And oil has now had this move since the SPR. So I'm not convinced that continued signs of weakness in China are anything major. I think China weakening has been a story all year. And despite that, I think oil is going to be fundamentally strong. Why do I think oil is going to be fundamentally strong with a weaker China? Don't those two ideas seem to conflict? Yes, all else equal, those two ideas seem to conflict. However, OPEC and the Saudis have very much prepared and been aware of this idea. They have delivered major cuts to combat the SPR. They want to get back to the levels we were at before the SPR came into effect and took oil prices down. They're signaling, they're posturing around announcements around the SPR have signaled this to me at least. We'll see how much follow through there is, but I feel pretty good that that's my read on it. So I do think that the China issue has been addressed, and Saudi has also indicated that they're willing to make additional cuts. So there has been a number of economic points this year that have led oil to have some significant moves down. I'm talking when SVB failed, when FRC failed. These kinds of things have been oil down 5% days. And those have all been local lows. So I think we'll see what happens. But I think a day like today, and I don't have this energy because I'm afraid, I'm actually very confident in this story, but may prove to be some sort of local low, or at least some sort of exacerbation that in the next few weeks will be at higher levels in the price of oil. That's what I believe. One more thing I want to talk about in oil, because one of my largest positions, one of the few stocks I've ever written a piece on that has been experienced a roughly 50% move since I wrote that piece. It was more like 60% at the highs, but has come back a little bit today. PBF, oil refiner, Bank of America, saying, oh, oil refiners have outperformed. They've experienced a lot of gains. It's time to realize some gains here. I don't think this is the case. I don't agree with this piece at all whatsoever, at least with the refining stock that I follow most, PBF. These companies are trading at ridiculously low multiples. They are very versatile in the kinds of products they can produce. They are, many of them, trying to produce renewable fuels. And there's lots of fuels that they can produce besides gasoline. And this piece isn't really even saying that gasoline demand is topped out. Let's not forget that has been a concern for many, many years. But I don't believe that's going to be the case for several years, even though there is some EV adoption, and this is something that's very well known, and this is why they trade at low single-digit multiples already, which is unbelievable when you have, massive companies trading at 20 plus. Anyways, you've got plenty of growth ahead in Africa and India, and even in China, which is experiencing tremendous EV adoption. You've got jet fuel, you've got plenty of other fuels and products that these companies produce, and they've continued to adapt to new technologies and new market dynamics. and oil is going to continue to be an essential material for and resource, regardless of whether or not cars are electric or not. So we'll see what happens. But these companies are trading at very low multiples, very low prices. They're buying back tremendous amount of stock, at least PBF. I can't speak to the other ones, but PBF in the last year has announced plans, or even the last 6 months it might be, plans to buy back roughly, let's just get they've planned to buy back $1 billion worth of stock already. So in the last, that's the last 2 earnings calls. So we'll see what happens in the next one, or roughly, maybe it was a couple weeks before or something. But they're buying back stock or announcing buybacks just about as fast as they can possibly do it. And because their multiples are so low, they can really go ahead and do this. So now it's a little bit less than buying back a quarter of the entire float. But that's just a tremendous amount of stock. So that is that's nearly as much as Apple has purchased the entire time it's had its buyback for nearly a decade. They've announced that in roughly the last 2 quarters. BTU is doing something similar, but that's obviously stock in a different space. So I don't agree with the refinery call. I think this is a very attractive area of the market. Oil is very attractive. The thing with refineries is they're not building another refinery. So you don't need to worry about the supply side as much as you would for something like oil. And gasoline has shown tremendous strength over, even more so than the price of oil. So I heard some arguments, if the price of oil is rising, it's going to impact gasoline demand. Gasoline, we haven't even gotten to what previous peaks are in terms of share of wallet for gasoline prices, meaning that historically the consumer has been able to weather gasoline prices higher than they have been, even at the peaks of last year, relative to their total spending before it has actually had an impact on demand destruction. So I don't see any reason why we're going to see some sort of, demand destruction that is worthy of concern. And refinery capacity, they're operating at maximum capacity. No new refineries are coming online. Demand is hitting new highs year after year, at least for the next foreseeable few years. These companies are trading at very low multiples, PBF less than a 2 trailing multiple, and we're getting up there in the crack spreads. Back to those crack spreads that we saw last year. So this trailing multiple, it's looking like that's at least close to what's continuing. Not many years to go. And they're buying back the stock. So I think it's a very good buy. And I wrote a very good piece on it. And you can go find that piece at leftskewed.com. And the stock is up roughly 50-60% since that piece. Past performance is not indicative of future returns. But you can read that piece and see what I was thinking at the time as a fundamental analysis on that company. At the time, I bought a lot of the stock. It is one of my largest positions, if not my largest position. So it fluctuates day to day. Today it might not be. Occidental. Let's see what this Occidental headline that just came in as we wrap up the oil topic is. Occidental to buy Carbon Engineering for $1.1 billion in cash. Don't worry about the EV thing and the carbon thing and the oil going away thing. EVs use plastic parts. They drive on roads, both of which require petroleum. Jet fuel, going to use petroleum for a long time. Batteries, very, very heavy on those planes. I would not worry about that. That is very much priced into these stocks, if not overpriced in these stocks. Now let's get into the next thing. Banks. We're getting a note out of Moody's, out of Fitch, which follows the note out of Moody's last week, downgrading the banks. I think this is a very valid report. Last year, if you thought stocks were bad, bonds were very bad, debt assets were very bad. What do banks do? They essentially create debt assets. They loan out money. So these banks have essentially taken a hit. There are a bunch of portfolio managers that have taken very big hits. That's just the nature of the situation. And unlike stocks, debt has continued to do poorly, and it's doing poorly right now. You look at this 10-year, every time you see longer yields in particular go up, assume bank balance sheets are getting hurt. So that is continuing to go on. I think this is a somewhat valid argument. However, for those of you who watch these videos and have seen a lot of these videos, you'll remember that I made a video saying JP Morgan is a new Apple. And I still stand behind that. I still think that's the case. I'm not buying JP Morgan today just because, my psychological understanding of markets is I already have some exposure. It's not my largest position. It's roughly a 5% position, which throws it right in the middle of the bucket. I wouldn't be afraid to take it up in the bucket, though. My psychological understanding of markets tells me that this situation can build on itself a little bit. Fear can get up. So if we see a bigger drawdown, I will be buying this JP Morgan stock. Why? Because Jamie Dimon has been preparing for this kind of thing. He's been saying he thinks interest rates are going to go higher. He's been saying hurricane. He's been saying recession. So I trust that JP Morgan has prepared themselves for this type of situation. Their leverage isn't out of control. They've been lending to high quality creditors. They know what they're doing. And their money, their incomes are going up as interest rates are going up. And they're benefiting as these smaller banks fail. They benefited massively from that FRC acquisition. So I think this is a classic case of the bigger get bigger. And I'm sticking with JP Morgan. This is just essentially going to be a divergence of winners and losers. It was previously everyone's kind of winning. Everyone's kind of whatever. It's super easy. Interest rates are going down. They don't have to pay anything on deposits. Now it's going to be a divergence. There's going to be big winners and there's going to be big losers. And that's just what it is. And I think JP Morgan's one of those big winners. I think they're prepared for it all. Now, finally, it's not all okay in the debt situation, in the debt markets. S&P downgrading the U.S. debt. I think this is a very valid, very okay thing to do. Let me get some water real quick. If you look at the U.S. debt situation, the amount of money we're spending on interest payments is accelerating as these interest rates go up. Jerome Powell said the era of secularly lower interest rates is likely over. It's possible we get into a recession. It looks like the Fed wants to engineer some sort of slowdown. And there's no propensity for the U.S. to cut spending, at least for this administration. And, if we get Trump back in, who knows? But it doesn't seem like he's going to want to cut spending either. Seems like we've come to an impasse with the political situation. So spending is a problem. Deficits are a problem. Interest payments are approaching the entire defense spending per annum. And it's going to get to a situation where we either have to raise taxes or print money and or both. Neither of which is a good thing. If we print money, it's going to make interest rates go even higher. It's going to be a spiral. If we increase taxes, the economy is going to slow, decreasing future tax receipts. Also a potential downward spiral. That is the crux of the entire financial system. If you have interest rates continuing to go up, 10-year continuing to go up, all of a sudden you're pushing the risk-free rate of return towards the average S&P return, and that's going to impact the S&P 500. Why? Because you were around last year, right? You didn't find my channel just being a novice dude randomly stumbling across this. I get like 10 views, 20 views a video. You're not watching to this point in the video unless you actually care somewhat. Last year should show everyone that markets can be very volatile. If you own the most loved names, even a company like Apple, you experience significant losses for the entire year. So are you going to subject yourself at these levels, these high levels, this above average historical multiple, to that kind of risk when you can take no risk and get close to the average return? No, you're not. And neither are the baby boomers or the people who control all the money who are just trying to cruise on in and have no stress. So that is the real thing. That is the real thing right there. That's why interest rates matter for stocks. Because baby boomers control all the money. They're getting older. They're retiring. Interest rates are getting closer to the S&P 500 average return. So they can just go and chill. They can just, Fed funds and chill. Whatever it is. However they want to do it. Doesn't really matter. But it's good enough. It's good enough for return. Last year, we've been all diluted by the TINA trade. There is no alternative. Now inflation's coming down, interest rates are going up. And this is a normal part of the economic cycle, but what comes after it is not ideal. Interest rates rising. Typically, the Fed increases interest rates as we're starting to get inflation, and when the economy is very strong, and then things tip. This is a playbook we've seen over and over again. Whether or not it ends up we see that tip remains to be seen. But in my opinion, it's more likely than not, as consumer savings continue to decline, the savings rate has gone down, and credit might begin to continue to get constrained. And credit is as good as printing money. So if credit is getting constrained, at the same time, M2 is getting constrained, money supply is getting constrained, it's not a good combination of things. So we'll ultimately have to see how this evolves. But I think oil is okay. I think JP Morgan's okay. I think shitty banks are not okay. I think the economy is strong now, surprisingly strong now. Has surprised me how strong it has been so far this year. But I don't think, and basically everyone, even the Fed, has been surprised. But I don't necessarily think the idea that it's all roses and fine and roses, and particularly the idea that earnings are going to grow 15% between now and this time next year is true. I actually think earnings have if they're going to grow, it's going to be because of inflation, not because of anything else, or cost savings. So that's not going to be broad market earnings, because one person's spending is another person's income. So I would assume that's going to be seen somewhere, at least at some point, even if there's a lag. Obviously a lag with Fed funds going up. Obviously interest rates will continue to rise in real terms as inflation falls, even once the Fed finishes hiking. A lot of things to think about, a lot of things to, in my opinion, be worried about, as we're at near all-time highs from a previously Goldilocks environment where stocks were well above their average historical multiples. All things to consider. So that's today's video, and until next time, peace out.